My name is Amelia Chapel, and I am the Digital Marketing and Creative Services Manager here at John G. Ullman and Associates. Before we get started, like Amanda mentioned, just a quick housekeeping note. For recording purposes, we kindly ask that you keep your cameras off and your microphones muted throughout the session today for recording purposes. At this time, I'll take a brief moment to read our disclaimer. The information discussed in this presentation is current as of the date noted, is for informational purposes only, and does not intend to address the financial objectives, situations, or specific needs for any individual investor. Any information is for illustrative purposes only and is not intended to serve as an investment, tax, or legal advice, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Joining us today is Lisa Fusco, one of our regional managers of the relationship development. Lisa will be moderating the chat today during the presentation. If you have any questions at any point, feel free to type them in the chat and she'll make sure to get them addressed. Now I'm excited to introduce our presenter, Amanda Herrick-Smith. Amanda is a senior advisor here at John G. Ullman and Associates, and she is also an active and proud alumna of Alfred State College. Today's webinar is presented in partnership with Alfred State, and we're pleased to be joined by Jason Scotti from the college as well. So a little bit about John G. Ullman and Associates is we are a registered investment advisor that was founded back in 1978. JGUA is an independent fee-based management firm that offers comprehensive wealth management strategies and services more than 950 clients nationwide. JGUA manages over $1 billion in client assets and has 4 locations along the East Coast. Once again, thank you for being here, and now I will turn it over to Amanda for today's presentation.
Thank you so much for coming today. I really appreciate you taking time out of your day. So what we're going to be covering today is the retirement landscape and charitable intentions. Charitable giving is a financial planning strategy, smart giving vehicles for retirees and pre-retirees, the tax advantage of giving, legacy planning, supporting what matters most, and a case study and real world scenario. So oftentimes people give to charities for various reasons, as a means of helping other people, providing a sense of duty and faith, and also personal connection to the cause. So here's some top motivations for charitable giving in retirement. The biggest one we see, and this is again from a survey from Fidelity, is making a difference. So that's for both pre-retirees and retirees. Also giving back to communities or in faiths, solving a problem, progress, or issue, supporting causes you care about, personal satisfaction, as well as helping future generations. So not only can charitable donations be satisfying, they can also come with some really great tax benefits. So giving is not just generous, but also very strategic. Giving can be integrated with income needs, tax optimization, and estate plans. Offset income in high tax years, reduces taxability of required minimum distributions, creating a lifetime income stream, and also just building a legacy. So financial advisors can help with playing a role in this progress. They can help by looking for opportunities to optimize tax, also for estate planning, and this just all comes together to help fulfill your charitable goals and aspirations. So one of the ways I want to touch on is qualified charitable distributions. So this can be one of the most tax impact way of donating to your charity of choice. And it also is a really great tax efficient way of doing so. So One of the requirements is you have to be 70 and a half years old. And for those that are receiving their required minimum distribution, usually it's around anywhere from 73 to 75, it can be very advantageous. So required minimum distributions are the minimum amounts that are required to be withdrawn from your retirement account each year. And the distributions from the IRAs typically are taxed as you withdraw. So one of the benefits is you can do a qualified charitable distribution directly to the charity of your choice, or charities for that matter, not exceeding $108,000 per year for per individual. And this actually is an instant reduction of your adjusted gross income, which can, in theory, then lower your tax bill. It can also impact things such as Medicare premiums, known as IRMA. We'll talk about that a little later, and even reduce the taxable piece of your Social Security benefit. So illustrated here, you can see two different kind of columns. The one on the left shows adjusted gross income of $93,000 with various income sources, while the area on the right-hand side shows someone that has done a $20,000 qualified charitable distribution. So that's an instant reduction of adjusted gross income of $20,000. So instead of having $93,000 of adjusted gross income, it's showing $73,000 of adjusted gross income. So it's an instant tax benefit of doing a QCD. So many of my clients will actually take advantage of QCDs, and it's done by filling out a form with the institution, notating the charity of choice. It does have to be a 501c3 organization. And then depending on the institution, they can earmark the check to go directly to the charity, or it can go to the client in the name of the charity. And sometimes my clients like to put a little note with their donation when they send it in. And so in order to do a qualified charitable distribution, the funds must come from an IRA. So a 401k or a 403b wouldn't qualify to do a QCD, but people can also do rollovers from their 401k or 403b to an IRA. But it's important to work with a financial professional to understand all of your options, as well as the pros and cons to doing a rollover. So one of the things I mentioned earlier is doing a QCD. It does have a direct impact in reducing your adjusted gross income. One of those things that it could benefit is reducing or hopefully eliminating the excess Medicare premium, which is also known as IRMA. So IRMA stands for Income Related Monthly Adjustment Amount. So there's various tiers, and you can kind of see it here small on the right-hand side of the slide. Based on adjusted gross income, you can fall in various tiers once you're 65 and on Medicare, where you would be paying extra for your Medicare Part B, which is the doctor component of Medicare, that premium, as well as the Medicare Part D, which is the drug or prescription component of that premium. So I'm just going to illustrate a little example here. So for a couple that's married filing joint, let's say they have income of $212,000, they would have no excess Medicare premium. So they'd pay their typical $185 Part B premium, which we all have to pay, that's the base, as well as their cost to their prescription plan or maybe their Advantage plan. And so with just one more dollar, so $212,001, they would pay an extra $74 plus $13.70 per person per month. So that would be a total of $2,104.80 per year for both people, just due to $1 of more income. So even doing a QCD of $1 in this example could completely eliminate over $2,100 of additional Medicare cost. So one of the things that you can take advantage of is if you know you're going to be in a higher tax year, maybe it's due to a bonus, selling a second property, or winning the lottery, you might want to consider donating to a donor advised fund and kind of front loading some of those donations to reduce the taxes that you'll be paying. So donations are deducted in the year made, but can be given to the charity of choice over a period of time, which is really great with a donor advised fund. And also the investments grow tax-free with a donor advised fund. So donors transfer, another idea is donors transfer appreciated assets into an irrevocable trust. So this is also known as a charitable remainder trust. And then the donor or the beneficiary will receive income over their life. It could be a set amount or a variable amount depending on the trust. And then afterwards, in this case, the amount would go directly to their charity or charities of choice. So one of the benefits is it avoids capital gains. There's lifetime income for the donor, and it also qualifies for immediate or partial tax deduction. So there are some legal setup costs to do this, to administer it, and once that choice has been made, it is irrevocable. So you can't go back and change it. So another technique is to donate highly appreciated long-term stock. So this is a great technique for most people. A lot of our clients will do either QCDs if they're over 70 and a half, and especially receiving required minimum distributions. They'll also donate stock, and that could be even before retirement. So if you have a stock that is highly appreciated with a lot of gain, you could donate that stock or maybe shares of that stock directly to the charity of choice. And what's really great about this is the charity receives the valuation of the stock. They could go in and liquidate that stock, and charities don't pay barely any income tax. So it's a great kind of win-win for both the charity and the donor. And the next slide here, we're going to show you the difference with someone donating cash versus donating the stock directly. So if you were to sell that stock, you would pay capital gains taxes, which here is shown in that orange area. We used 15% for the capital gains rate and 6% for the state tax. And so the charity would receive the $39,500 in this example. Now, if the stock was donated directly, what's also known as in kind, to the charity receives the full $50,000. So what's really great about doing a stock donation is if you're able to itemize your deductions, you can take the fair market value of the stock donated, and that will help hopefully offset some taxes for you. And the money that would have originally donated to the charity can then be reinvested in new stocks, or maybe you want to just buy the same stock, and it kind of resets that cost basis or resets that gain. So the next slide here, we're kind of summarizing some of the things we talked about so far today. The one being the qualified charitable distribution for those 70 and a half or older. There's also setting up a donor advised fund, which you can really use at any time, and they're great to use in those years that you know you're going to have a lot of income, because you get the tax benefit right off the top that year in which the donation goes into that fund. There's also the charitable remainder trust that could set up that will help to remove some of those assets from your estate and appreciate outside of your estate. And some of those tax advantages of doing the charitable giving is it could help reduce your Medicare premiums, also known as IRMA. Also, Social Security taxes, they are tied to your other income. So depending on the taxability of your Social Security, you may be able to also reduce that. One thing I haven't really talked about a little bit is the net investment income tax, also known as NIT. So for adjusted gross incomes below $200,000 for a single person, $250,000 for a married person, you could avoid that 3.8% surtax. So another good reason to, reduce some of your adjusted gross income, maybe doing a QCD, is to avoid some of those extra taxes that are on our investment income. So the tax advantage of giving, so you want to focus on those high income tax years. Those are some really good tax planning opportunities. Even for those people that might want to take advantage of doing Roth conversions, if you know you're going to be having a high tax year is because of those planning opportunities, that could be a great time to do some charitable giving for yourselves. Also, after retirement, we talked about doing the QCDs to satisfy or help reduce the taxability of your required minimum distributions, and also the impact of Social Security and Medicare with taking advantage of those. So here you can see in the chart kind of the most impact to our adjusted gross income or the tax benefit. The top one is absolutely the qualified charitable distribution, just because you get a reduction in income right off the top. There's also the donor advised fund, the charitable remainder trust, and kind of last would be the direct gift of securities. So charitable giving can be also done through the use of your estate plan. So one is you can list in your will or a trust a specific bequest to your charity or charities of choice, such as listing Alfred State. That money, if done in a dollar amount, would go directly to the charity, kind of right off the top, before the remainder amounts go out to your heirs. You can also identify a percentage to go to various charities as well through your wills. Another planning opportunity is to list a charity such as Alfred State on your retirement plan. So what's kind of nice with listing a beneficiary in your retirement plan is for those retirement plans that are traditional, meaning that all the contributions are pre-tax. So when you take money out, you get the privilege of paying tax. With listing a charity as a beneficiary, the charity doesn't pay practically any taxes. So it could be a really great opportunity to kind of save tax in the whole family and your whole plan by listing a charity as a beneficiary on your retirement plan. And plus, beneficiaries can be updated at any time too. So you can change your plan throughout the years pretty easily versus updating your estate plan. So some of the other tools is the charitable remainder trust. We kind of talked about that a little bit, as it provides income to you and your heirs. It could be an income stream that's fixed or also variable. And the remaining assets you can designate to a charity. There's also a charitable lead trust, which is a little different. It's the inverse, where it provides immediate support to the charity for a term, and then it passes the remainder to heirs, often with estate tax advantages here. And we talked about the donor advised funds, making contributions during your lifetime into this fund, which is immediate tax benefit. And then you can deliver grants over a period of time to your charities of choice, such as Alfred State. And some other tools is family foundations and endowed scholarships. So you can establish a family foundation. There's typically a lot of costs associated with setting these up. Also endowed scholarships, which I know Jason helps and his team helps with to set those up with Alfred State directly. It's really important to have these conversations with your family, to share with them your intentions, so that way your legacy can also be continued and your wish is fulfilled. So the next thing I'd like us to take a look at is a case study. So let's start with a real life scenario here. Here's an executive at a tech firm receiving $500,000 of stock-based performance bonus, pushing their income up significantly for the year. So rather than letting taxes eat into this windfall, the executive takes a strategic approach. They use a donor-advised fund. So here's what they do. They contribute $100,000 in appreciated stock long-term in a donor-advised fund before year-end. That contribution is fully deductible up to 30% of their adjusted gross income. And there's no capital gains tax on the stock because they didn't sell it, they donated it. So instead of paying taxes, the $100,000 grows tax-free in this fund and can be granted to charities later, even years down the road. So in this case, the executive plans to distribute $10,000 per year for the next 10 years, supporting the education, the arts, and also medical research. This is a powerful way of giving back and also cutting taxes at the same time. So here's a comparison. Without the donor advised fund, they'd owe capital gains and have higher taxable income. With the donor advised fund, they get a $100,000 charitable deduction, rather reducing their taxable income and also avoiding $14,000 in capital gains tax. Plus, they've set up 10 years of charitable giving, all in one strategic move. So that concludes the base part of the presentation today. We welcome any questions. If you have any questions, feel free to put them into the chat box and we will see what we can answer.
There were a few, this is Lisa, there were a few questions that were submitted in advance. I can start with them while other people start getting their questions in the chat box. So the first one that I have is, can an inherited RMD be used to fund a charity trust account without paying taxes?
Yeah, so let's kind of break this up into a couple of different pieces. So an inherited IRA requires minimum distribution. So that's the minimum amount that has to come out of an IRA that was inherited from a decedent. So for those that are 70 and a half years old that inherited the IRA, they can use that to fulfill their QCDs, their qualified charitable distributions out of the account. So the answer to that part is yes, you can do QCDs from the inherited IRA once you're 70 and a half. Now, as far as combining it with a charitable trust, that cannot be done. You cannot fulfill a QCD, kind of routing it into a charitable remainder trust. So that part of the question would be no, you couldn't fulfill that. Thank you, Lisa. I appreciate that question today.
Thank you. We have another one here. What's the best way to give for a student who is academically qualified but would not be able to school without this scholarship?
Okay, so in order to receive a deduction for any charitable contributions, the donation would need to go directly to the 501c3 organization, which if we use like Alfred State College as an example, the donation from the donor would need to go directly to the financial institution. So the financial institution would be that you'd want to work with to see if you can set up an endowment, and maybe through that endowed fund or that donation, identify a way of routing it to the recipient in a way that kind of fulfills and meets the college's requirements. So you can donate to the school in any various ways we kind of talked about today, in the form of doing a QCD. You can donate highly appreciated stock. You can donate cash. So there's so many other ways you can donate to that organization, but in order to receive the tax benefit, it needs to go to the school versus an individual. Now, kind of outside of charitable giving, any person can give another person up to, I believe it's $19,000 per person per year is a gift, but that would not be deductible. That's just a gift as part of the annual exclusion.
Great, thank you. We have one more that was submitted in advance. Are charitable donations made to religious institutions include these tax benefits and exemptions?
So donations to religious institutions could also qualify. It does need to be a 501c3 organization. If you do go to the IRS website, you can actually search various organizations to confirm that they do have the 501c3 status. Most oftentimes, religious institutions will, and a lot of times what we find is our clients, they might have a connection with a religious organization that they tithe to, or really would like to donate quite significantly to. So you can use a lot of these tools that we talked about today with the QCDs, highly appreciated stock, and other various forms to donate and get the funds to these organizations that you would like to support.
Great. There is a question in the chat box. Once you're on Medicare, can the cost be adjusted based on any of these actions?
So very good question. I'm going to talk a little bit more about the excess Medicare premium, which is also known as IRMA. And so I'm going to go a little bit deeper into this. So with the excess Medicare premium right now in 2025 that's being assessed, it's actually based on the tax return that was filed in 2023. So if the adjusted gross income in that tax return is higher due to maybe employment, and maybe since then that individual retired, there is a form that you can fill out to let Social Security, which is actually where you would file it through, know that you had a change in status. Maybe it was divorced, maybe it's because of employment changes, where you might be able to actually reduce that excess Medicare premium with those qualified changes. Now, sometimes people want to try to fill out that form if they had an income change, maybe, that year they did a Roth conversion, or they had significant capital gains. Those types of things don't qualify to fill out the form and do that adjustment typically. So you can actually do some planning, as we kind of talked about today, with maybe doing QCDs or reducing your adjusted gross income to hopefully reduce or eliminate some of that excess Medicare premium. So that is a huge planning opportunity that we take advantage of for our clients here, for those that are on Medicare, which begins mostly at 65 for a lot of times for people, or maybe when they're done working with their employer and no longer on that health insurance plan. So thank you so much for that question. Well, thank you so much for joining today. I really appreciate the time you've taken out of your day to learn a little bit more about all the various charitable giving options. And, feel free to visit our website at jgua.com. There's many other blogs, presentations, upcoming things. And of course, reach out to Alfred State, the institutional advancement team, which is amazing, and they can help you too with any questions you have with setting up an endowed scholarship or charitable giving. And thanks again for the time today. I really appreciate it. Have a great day, all.